All right. It's showtime. So we're going to start rolling the next clip to introduce the next topic. Fundraising. So this is the biggest topic that creates a lot of angst among early stage entrepreneurs. It's a big topic to tackle. You will see in similar montages, you'll see sort of a collage of different perspectives from entrepreneurs, your peers. But also you'll start hearing from some folks, some investors that are exploring new models. And this will be a nice way for me to then give an introduction to our next speaker for the next topic, which are the new funding models. So without further ado, we'll get rolling.
I knew I was going to start my own company one day, but I set myself a syllabus of things I had to learn. So I had to learn business. I was reading about startups all the time. I invested in some of my friends who started their own companies just so I can watch what happens.
Fundraising for us it's a daily practice. So you get up, you fundraise, you get up, you fundraise. It's something that you think about every single day.
You learn over time the implications of an institutional investor versus an angel, which would then inform my strategy next time I do this. But I only knew that by doing it. And I feel like now I'm much more prepared to do it again, much more efficiently.
You know, if you don't want to do a lot of work, I would suggest a whole other business, because this is, in biotech and when it comes to funding, you're doing sprints and marathons on a daily basis.
Knowing what I know about the subtleties of investors and who invests in what and why and how, I would be able to very quickly move into the areas that make the most sense for us.
We approached all these people initially as mentors. We got to know them very, very well as mentors. It also gave them a chance to really get to know us. Because it's a seed round, we want and expect that there will be a lot of transparency. So we didn't try very hard to hide the things that we think are ugly about our business.
Start developing relationships sooner, even if you're not, even when you're not even planning on raising money yet. You just want to always continuously expand your network.
When we try to think how the system might change and who would get interested in putting in seed funding, I think we're more excited about the big pharma and other life science companies. You know, they are in a perfect storm. They're looking for new ways of doing things. A very effective way of them getting a big bang for the bucks is to put some money into early startup companies.
And these companies, a lot of them have really good cash position right now, and so they're healthily investing in new companies. And so we've gone after those corporates, and that is helping us gain traction with the pure venture capital world too.
My belief and advice would be ensure that the technology is really transformational. Incremental advances are not really very valuable to customers or investors.
We surround these innovators with the help that they need, and then we also give them some funding to get them started, and then we work a lot with them as they move along their pathway to proof of concept with who they need as far as financial support.
New technologies take a great deal of time in order to mature sufficiently to develop into companies. Quite often that could be 10 years or often 20 years. And so the idea of an evergreen fund is that we invest in startup companies without any fixed idea about when we have to exit those companies.
In the beginning, we thought about a very traditional, let's go to the VCs, let's get the money we need, and we'll get up and running. I think in the beginning, after a while, that didn't quite make sense for us. We knew we had a customer that really needed our product, and maybe they were the ones who could partner with us. And that's actually been our first approach, is to go to the customer and actually see if would they be willing to invest in us. And then through partnering with them, could we actually create a product together that meets their needs specifically. And that's really the approach we're taking now.
The direction, I think, in which traditional venture capitalists are moving is we're very happy to invest once you've shown us that you have customers. Now, that's maybe a little bit of a translation from the lean startup philosophy that's been being applied in tech these days. It doesn't perfectly translate to biotech. But the point is well taken. Instead of building it and hoping they will come, let's only build it when we know someone's already there.
So one of the hard things about meeting with potential investors, especially venture capitalists, is not taking their advice. Kind of ignoring their advice and going your own path for a while. They see lots of failures, but as an entrepreneur, first-time entrepreneur especially, you're not aware of failure. So you sometimes have to listen to or not listen to advice from people who failed a lot because it doesn't necessarily apply to your situation. You've got to think that you're the only one that's going to succeed.
I was talking to a young lady from a company that desperately needs funding. And I described to her our strategy. I said, you need to do it every day. Everyone in the company needs to think of this as something that's vital. No money, no science. You need to find a way to think of these programs as it has to be part of your culture. And she said, the grants that are available to us are too small. And I thought, just take all of them. Just put them all together, make a quilt, and cover yourself.
It is my pleasure to introduce our next speaker. Allan May is one of the most well-respected angel investors in our community. He's also the founder of the most active and successful life science angel capital network in the Bay Area, and arguably in the country. A lot of folks actually are trying to emulate and copy his models on the East Coast, and so that's a great testament to the quality of the work he does. The reason I asked Allan to come and talk to us and share his perspective of what the landscape looks like is not only because he has a lot of experience, he's invested in many companies over the years, but he really cares about this. He really cares about this community, what is happening, and what the changes are currently occurring. So without further ado, please join me in welcoming Allan May.
Okay, how we doing? Is this the 2 o'clock, like I need a caffeine high thing, or is this, you all punched up? So let's talk about the little pesky money thing that gets in the way here. So first, thanks, Lisa and QB3. Our industry is in real trouble. More precisely, innovation and entrepreneurship in our industry is in real trouble. And this sort of thing is sorely needed. And the focus on business model just could not be more pertinent or more important for ourselves. So just thanks to them for realizing that. I'm going to apologize in advance for the density of these slides. I put way more stuff in here than we're going to talk about, but I want them to give you the slides. You can take them back, and if that's of any value to you, then that's terrific. And the one thing I think you'll get as a takeaway from this is we don't have the answers. In fact, you are the ones who are going to have the answers to the problem here. So what I want to do is just provoke your thinking a little bit, hopefully be a little bit controversial, and see if we can find some ways through the forest. First, who in the audience are investors? Okay, so those of you who are entrepreneurs, you should swarm them like angry ants. So that's just so I say one helpful thing at least. All right, so we're going to talk a little bit about where we are and why we're here. I'm not going to spend a whole lot of time on the doom talk that I normally give. But I do want you to understand precisely where we are and what's going on. So our world collapsed after 2008. What happened in 2008 was not only the collapse of the U.S. financial markets, but when the U.S. financial markets collapsed, because everything is based on mathematical formulas tied to asset class allocations, and since venture capital is a part of the equity asset class, all of a sudden the big equity players and LPs, limited investors, found themselves overweighted in public stock. That meant they had to dramatically reduce their investment in equity, ergo venture capital. At that same time, somebody bothered to look around and say, hey, you know what? These guys haven't made any money in 20 years. What the hell's up with that? Kaufman just put out a report, boy, if you haven't read it, everybody should read it, that actually takes LPs to account and says, where were you guys for 20 years when you were giving them all of our pension fund money, and 9 out of 10 of them couldn't beat the public index returns, right? It was a thing that totally didn't work. So in any event, it's had a big impact. So what does that look like graphically? It looks like that. Fundraising has essentially dropped somewhere like 2/3 in United States venture capital. What does that mean? It means the number of funds that are available to give money to startups has fallen by 2/3. It means the amount of capital that's available to give startups has fallen by 2/3. Just like the government, all governments, somehow they still spend twice what they take in. So not only aren't they taking in what they used to take in, but they're still spending like they used to spend. So this portends poorly for startups. The two implications of that are that VC firms increasingly spend their money propping up companies they've already invested in their own portfolio, and they have increasingly shied away from early stage investment. What does that look like in biotech and medtech? In biotech and medtech, it is pretty dire. Of all of the sectors that are under siege, probably clean tech would be the only one even close in terms of drop in capital and drop in number of startups as biotech and medtech. The number of startups, seed and first round investments, is now under 100 in the United States. This is just unparalleled in history. I noticed on Hallie's slides, Halle Tecco on her website lists 71 companies that have been funded so far this year in healthcare IT. That, I think, is more companies, seed companies, than have been funded in all of medical device this year. So there are some really dramatic things going on out there in our world. So 2011, 2012, exactly where are we? The money now is down to $1.5 billion. There used to be $4.5 billion invested a year in healthcare. So 2/3 of the money has disappeared, right? So there's not enough money to fund what they've already invested in. Then here comes this wave of entrepreneurship. We have never in the history of the country, I think, turned out more entrepreneurs in medtech, biotech, diagnostics, healthcare IT, and done a better job of it, right at the same time that venture capital is really drying up. I'm not going to get into sector specifics. You've got some divisional breakouts coming out after that, and those panels can stretch on that. But we're down to Series A financings, according to the published data. We're down to 11 deals in the first quarter of this year. The LPs, it's gotten so bad from the venture standpoint that the people who invest in venture capital are telling the VCs not to invest in biotech and medtech. So things are looking a bit dark, we could say. PMAs, you know that PMAs are the long, more complicated pathway, regulatory pathway. By definition, they are innovation. The 510K, they had a blue one, you're going to make a red one, that's the incremental improvement. You're going to replace the blue one with a red one, that's the PMA. We're down to 10 PMAs now being approved in the United States. Why is it happening? Everyone knows why it's happening. The cost, time to exit, and complexity risk of medtech investments has dramatically increased in the last decade. The cost, complexity, and time to exit of IT and internet investments has decreased substantially in the last decade. Where does this money go? Why is that? These are both technology-driven investments. How can one be up a log and one be down a log? 3 letters. FDA. 75 to 80% of all the money a startup will ever raise and spend will be spent on the clinical trial. Even with that, 2/3 of those companies will get it wrong and won't hit their endpoints. And incidentally, reimbursement trials and outcome trials are coming too. We're not even going to go there because that gets way too seriously depressing. What does that look like graphed out? 510Ks and PMAs over the last several years plummeting in the US. And let's say you're lucky enough to invent something, discover something, build it, prove that it works, have intellectual property, get financed, actually get it through the FDA. But here's reimbursement. They're down to disapproving 2/3 of petitions for reimbursement that are filed. So if you can get it approved, they don't want to pay for it anyway. So that's the little world that we're walking into. So what does that mean? Do we all just give up and go away? No. Things are evolving. We are in an evolving period. The thing that is perfectly clear, we know that the system that worked in the previous 2 decades is not going to work going forward. We don't know what system is going to be in place 10 years from now. We are in that little period of churn here in the middle where we're all trying to figure out, wow, where do we do now? Where do we go? What's coming up? So this is the takeaway slide. These are the things we're going to talk about. These are the biggest changes, I think, going on in our industry. And we're going to take each one of those and just spend a few minutes on them. And I want to do this quickly because we've got such a fabulous panel. We want to have their input on all this. So look, angels have always been the answer anyway. It's just, it was overshadowed by a bunch of venture folks. But there's $20 billion of angel money invested every year. There's about $20 billion of venture money invested every year. So what's the difference between angel and venture money? Well, first, angel money is it's our money. We're not fund managers who get paid to manage somebody else's money. This is whether we send the kid to college or invest in your company. That's the kind of money it is. Secondly, it's virtually all focused on the seed round and early stage. 85% of angel money is focused on the early round and seed stage. Almost 90% of venture money is focused on the commercialization or expansion round. So it was always a bit of a myth that VCs funded seed or early stage, particularly in life science, although there are firms who do fund life science, some of which are in this room. Following 2000, angel groups exploded. There are reasons for that related to the collapse of the markets in 2000 and a way to protect ourselves. But what's more important about this is not the growth in number, it's the growth in sophistication and best practices. As we did this, people started to focus on investing. It became less of a hobby. It became more of a, what are the best practices? What about diligence? How do you do these things? What correlates to better returns, et cetera? These groups are about now where venture capital was in the 70s as an industry beginning to really specialize and focus on returns. LPs are now talking about angel groups, angel investing as an asset class. So it's been quite a shift. What's pivotal to us here in the room, 25 to 30% of angel money in the United States, that $20 billion, is spent on medical devices, biotech, and diagnostics. It's a huge amount of money being spent every year. It does break out heavily in favor of medical devices. Two things. Let me say this about the data. This is, there's very, very little data on this kind of early stage investing. This is Kauffman. So Kauffman created the Angel Resource Institute that I happen to be chair of. Angel Resource Institute sponsored these studies with Silicon Valley Bank and CBI out of New York. This is our first year of data. We only found $1 billion worth of deals and about 1,000 deals. It'll take a number of years, 3, 5, 10 years, but someday this is going to look like Pricewaterhouse Money Tree, so you got to start somewhere. But it's showing already a real desire to invest in early stage and in devices, and it's even showing a desire the ability to invest in biotech and diagnostics, and we'll talk more about that. So a couple just really key things about angels. The interests of founders and angels tend to be much more aligned than with other investors. The way the current financial system works, the more money you raise, the more likely it is the last investor in will take preferences on their investment, sometimes a 3x with a participating preferred. You can look that up, but it's a bad thing. And what it means is amount of money that the firm gets on exit doesn't mean founder did well. In fact, one can argue that the more money these startups raise, the more poorly a founder does. Founders and angels are in the same place vis-a-vis dilution. The more money you raise, the worse you do as founders, the worse we do as angel investors. We were in a company where we were Life Science Angels was in a company where we were the first deal in, first money in, $1 million. That company went public last year, and we got back 20 cents on the dollar. Why? It had raised $300 million. So I'm not going to spend any time on this, but how do you access angels and how do you get to angels? You can just look at the slides later on. This is important because it means there's a much greater variety of business models that angels will finance. And so when you're making your business slides and presenting your pitches, you've got a lot more flexibility in how you tune and aim those pitches when you're dealing with angels. This is the second big change going on. Syndication has now become the norm. 2 or 3 years ago, groups tended to work in isolation, like venture capitalists did originally. Now already 2/3 of all deals are syndicated. Those syndications are being explored in every possible combination. Multiple angel groups are now completely routine. High net worth individual, micro VCs, and angel groups are exploring together. Biomedica just raised $12 million. We have a Russian VC fund. We have a German high net worth individual. We have 2 micro US VC funds and a series of angel groups in that deal. Smart Cells in Boston raised $10 million, all angel money, high net worth individuals, no VCs. This is really exciting. Family offices and foundations are beginning to show up in our field. This is really, really, really exciting. These people have the money to help us to an exit. They don't have the skill set in helping early stage investments, so they need to co-invest or direct invest alongside people who can add value at the early stage and help these young biotech and medtech companies overcome their initial problems. Guess who does that really well? Angel groups with cashed out entrepreneurs from medtech and biotech. So this is a really exciting trend. Patient advocacy funds are showing up more and more in these syndicates. And the med device strategics have now discovered what the pharma strategics discovered. This isn't about taking on risk and financial returns. This is about protecting their pipeline. If they want PMAs to be started today so that they can invest in them 3 or 4 or 5 years from now, they have to participate with us now in the initial rounds of funding of those PMAs, or we won't fund them, and they won't have a pipeline. So this is a big change coming up. We talked this morning about GE Health Imagination. I'm sure Hallie's going to talk about that. That's going to have a blockbuster impact. Foreign funds are beginning to come back in the U.S. Skolkovo Fund, you've all seen the news reports on them coming through the Valley this week. That's a really big deal. Tech has now become active. This is a group that finances Chinese entrepreneurs with mainland money coming back in the United States. There are trends like these that will impact our industry. The ones we're going to talk about here a little bit more today, universities have realized that just having proficient tech transfer offices and getting the technology out there and giving them a pat is not good enough. They've got to participate with these companies. They've got to get out there with them, help them succeed, take risk, et cetera. We've got some great examples of that coming up on our panels. Nonprofits, very exciting. We've got Fogarty Institute, QB3 here today, the Royal Enterprise Fund, Rock Health, a number of these groups, whole new models. I don't think, were there any nonprofits like this 5 years ago doing this kind of stuff? I don't think there were. So this is huge. Calder Foundation Breakout Labs is Peter Thiel's effort to do this. So these are going to have big impacts on our business. So now what do we need? We definitely have got to have new business models. So we know that the old system won't work. We know that a new system is needed. We know we have to have better patient outcomes on less capital with lower money. We need new value propositions. We can talk about this later. We all know reverse innovation is coming. Interestingly, it's still very hard to get venture financed. Both these companies got financed, but we hid the fact that they're good examples of reverse technology. We can talk more about that. We don't want to spend time on this. Let's just look at a couple of quick business model differences. The one on the upper right, somebody usually said, yeah, that's a dime. No, no, no. The other thing up there on the right, that's a leadless cardiac pacemaker. We built that for $10 million, $1 million in angel money, $9 million in venture money, and we got a deal with a strategic to buy it for $100 million up front with $100 million earnout. Not fantastic, but not bad on $10 million. So that can be done. The second deal was the one I told you about. The one at the bottom is synthetic cartilage. That's the deal with the German high net worth individual and the Russian fund. So new combinations, new techniques. There definitely is good news. Here is the last piece of good news. M&A is coming back alive. M&A went dead on us for a couple of years. They were protecting their money and not buying, and when they did buy, they were buying at rock bottom prices and taking advantage of us. That's changing. They're coming back in. The size of the deals is looking attractive. And as these exits occur, and those VCs who are in those companies get back returns in the angel groups, that'll spur interest back in early stage investing, and you'll see the cycle repeat itself, and we'll be coming back in. Hallie's going to help us understand what healthcare IT is all about. We'll just leave that one for her. And then we'll start our panel. Can I ask Hallie and These are 4 examples of things that I don't think existed 3 or 4 years ago, or if they did, they surely didn't exist with the structure, organization, and execution capabilities that exist today. So maybe, Reg, if you'll start us off, Mission Bay Capital, QB3, that's got to be one of the most successful public-private partnerships in the country. Could you describe a little bit what you're doing?
Yeah, so I'm Reg Kelly. I'm an academic. I'm a professor. I've been a scientist most of my life, and I'm trying to approach the problem that we're facing here as a scientist. I don't know the answers. I'll do experiments and see what works, right? And so what did we try here? We realized that universities had to come down from their ivory tower and do something about the problems of society. And one of the things that we said, how can we best do that? So there are two things we obviously have to do, right? Is to increase the probability of success of companies and reduce the cost of forming them. That's the only two solutions. They all fall into those categories. How do we actually improve the probability of success? We try to actually de-risk the companies as much as possible while they're still within the university. So we do this in two ways. For example, we now have a high-throughput screening facility, which has a couple 100,000 drugs, which we can all fully robotic, so we can test things. And we've brought people back in from industry to run them within the university so that we can do this type of thing. The second thing is that was to try and find out, is there a demand for, is there a whole pool of university research that's not getting out and could benefit society? So with help of money from $1 million a year approximately from a donor, we're able to show that 20% of our faculty actually had research which was post-NIH, which could benefit society, but they had no money for the last 100 yards. So we were able to fund some of those. Of the first 9 we funded, 5 of them turned into companies and 3 of them into patents. So if you have the money for that last 100 yards, you can make a lot of difference. This is the big constriction point for getting this stuff out of universities into society. Then when you get them outside the university, the key thing, as we talk about a lot today, is lean startups. How can you adapt the lean startup model for the biotech industry? We've been very much involved, my colleagues and myself, in trying to do that. One of them is that faculty members in general make pretty lousy people to run companies. You know, they're very distracted. They've got lots of other things to do. You need someone who can work 24/7 on peanut butter sandwiches. Graduate students and postdocs are perfect. They've had years of training to do that, right? So we try to encourage them to start companies, but they don't know much, so we have created a mentorship thing, which isn't to give classes and lectures. We actually have a startup in a box program that takes the student and runs them through a checklist of everything they have to do, start up a company, set up an account, and so on. But for each of those, we have someone who's willing to do it for them, so that lawyers who agree pro bono to do freedom to operate things for them, or we already have a bank that will give them free checking accounts. So this is not just another lecture course. This is actually a hands-on how you do that. So we have we started this 6 months ago. We have about 40 of these people already in our Startup in a Box program. So we first get them some training. Then they don't have any money, right? They are living on their credit cards. So what we try to do is to come up with our own venture fund. So although my colleagues and I have absolutely zero venture experience, we're able to raise a very tiny fund. We didn't want to compete with the big funds, so we tried to raise just a 10 million fund with 1 million from 10 LPs. It was 2008, a tough year, but we raised 11.3. It turned out not to be so difficult. Why are we doing this? Well, the idea, again, is because all my life I've been spending judging scientists. That's my job as a professor, right? So we actually can tell who are the good scientists, particularly who are the good scientists and who are the good science coming out of universities. We couple that with incredible pro bono mentorship from people like Brooke Byers, of Kleiner Perkins, Caulfield Byers. They give us help to select the correct companies. So we've been invested in 8 companies over the last little while. Last thing I want to mention here is we also, and Doug Crawford, my colleague, will talk in the next session, which I strongly recommend you hear. We've been able to start the idea of, can you actually have an incubator, which is a little bit like adapted to the life sciences. We have a micro incubator. You can rent out a single space. It's only a single bench, 200 square feet, a couple $100 a month. Started this about 4 or 5 years ago. Quite incredible. We've had 63 companies go through now. We've got 45 currently. We're on 5 locations here. We're getting demands 2 to 4 per week to be into our incubator. It's working extremely well. How do I say that? Well, we've managed in this short time, on only $6 million coming in from the university, to create 280 jobs and bring in $230 million in outside funding into those companies, right? Now when you have 63 companies, you can begin to get some numbers. This is why we're sort of an empirical approach to this. So despite what Allan says, of those 63, I only think about 2 of them have got funding from foundations. So currently, as yet, it's not picked up to be a current thing. It's about 25 million came out in small business grants. Still, the bulk of the money coming in is coming in from angel and venture investors. So we're still able to bring, in a few years, a couple $100 million in to start companies. So I think this new system of coupling innovation centers and incubators with universities and getting a very strong partnership can really work quite well.
Super, super. Thanks, Rich. Hallie, Rock Health has erupted onto the scene and probably had more impact in healthcare IT than any other single organization. Tell us a little bit about what Rock Health does and how you do it.
Sure. Yeah, Rock Health is a nonprofit, and we really bucket ourselves into 3 activities. The biggest is the incubator, but we also have tons of research and media that we open source for entrepreneurs in the space, just like Kauffman, and with the support of Kauffman, as well as events to bring people together. So everything that we do is really all around supporting entrepreneurs who want to be educated about the opportunities in digital health. In terms of our incubator, we've been live for a year, so we've been working on it for 2 years. We started our first class a year ago, and we've had over 800 startups apply, and we've had over 26 startups graduate. Our last batch graduated last week, and then we have 7 startups in the program right now. And it's a very structured, it's similar to grad school. It's an incubator, so it's in-house. It's really a required piece of the program is that you're actually there because you're giving to the other startups around you by just sharing knowledge and sharing stories. And we have, actually similar to QB3, we bring in really great mentors and operational partners, the legal stuff, to really help startups get off the ground more quickly and increase their probability of success and lower the cost of starting a company. So we recently, we're still too young to fail, fortunately. So the numbers look really good right now. We've had over $11 million raised from our startups. The majority of that is angel money. Because our incubator is still very young, the startups are still very early, the most a team has raised is $2.5 million, and that was from angels. And we've had 2 startups acquired or merged, which was pretty neat. And things are going quite well. Our current class is actually in conjunction with Harvard Medical School. It should be here at UCSF, but Harvard moved faster. And we actually sent 7 teams to work at the hospital for the entire summer, working on their businesses. So this is a neat way that we're working with the providers in addition to our other partners. It's an experiment for us, but we think it's a model moving forward that the startups will get a lot of value, not just being with themselves in our geeky office, but actually being within the system.
I forgot to ask, and so I'll ask both of you and then all of you. So, Reg, you do give small amounts of funding to these companies. Do you take equity?
Yes, we take equity. Yeah, usually we try to give about $500,000 to a company, so it's very small. But we can often get syndicates because other people, especially companies who are looking for strategic investments, they sort of realize we're doing due diligence for them. So we actually have a lot of interest for syndicates.
Do you price the round?
We haven't done that yet.
Hallie, how about you?
I like that you said $500,000 was small because we give $20,000 for the startups, and we don't take any equity. It's a non-dilutive grant.
Andrew, you've certainly got the most prestigious effort up there. I didn't know, as I learned yesterday, that the Royal Society is a worldwide society and not just a UK thing. But can you tell us a little bit about what you're doing and how you do it?
Okay, so I'm Andrew McIntosh, and I normally wear a tie because I come from east of the East Coast. But I took it off. I'm trying to be culturally sensitive here. But I sort of feel a bit, anyway. So I work with an outfit called the Royal Society, which is the UK Academy of Science. It was founded in 1660. It is predominantly UK, but it is international. 30% of the fellows that it elects each year are overseas. There are 40 fellows of the Royal Society in California, for example. And the Royal Society is an outfit that supports excellence in science across the board, so publishing, policy, conferences, grants, a whole range of activities. And unlike, the nearest thing here is the US National Academy of Science, but unlike the NAS, the Royal Society is determinedly independent and objective and separate from government in a way I think that the NAS is not. That gives us an interesting place from which to generate a seed fund, and I joined the Society 4 years ago to set up a seed fund, and it's an interesting model because it's based on the input to the seed fund is donations. So we go out and we raise money philanthropically. We're a charity, and we raise money as a charity because there are people out there who want to see the Royal Society use its unique reputation and position in the world of science to influence the scientific community, and that's why they're giving us money. We then create a seed fund. We invest in startup companies which have technology as the basis for the competitive advantage, so life sciences, but across the board as well. But unlike what you might think with a charity, we are there to make money. So we have a commercial view on the investments that we make. And the idea is to create an evergreen fund where we invest the money, we get returns, we put them back into the fund. So we continue to raise philanthropic funds and we invest. And that gives us a rather interesting position from which to support startup companies. So a bit like Reg's fund, we're about the same size. We've raised $12 million, and we've invested in 5 companies. And like you, we're too young to have failed yet, so it all looks very good. And the deal flow through the 1,400 fellows of the Royal Society and the networks around the world is very strong. The due diligence that we can do on a startup company using the elite scientists around the world is unique. And then the attachment of the brand of the Royal Society to a startup that doesn't have its own brand, that is trying to develop its own identity, gives that company real leverage when it's going to raise other funds. So there are a number of interesting things coming out of applying an elite brand to the area of early stage investing, and we're still exploring how those opportunities can play out.
Super, thanks, Andrew. Mike, Dr. Fogarty is probably the most well-known inventor physician in the United States, a recipient of the Lemelson Award from MIT along with Edison and Einstein, and famous for his prowess in medical devices. What is the Fogarty Institute for Innovation doing, and tell us how you operate?
Yeah. As you mentioned, Allan, the Fogarty Institute really started as the brainchild of Dr. Fogarty, of course. He realized that it's very tough to innovate around here, as people know. It's tough to take those innovations forward and deliver them to the patient, particularly perhaps in the medical device area where Dr. Fogarty is from. To support that, he decided to establish an institute where we surround that innovator with all sorts of resources they can use to develop their innovation and deliver it to patients. The manner in which the types of resources we surround the innovator with include mentoring, as has been mentioned before, mentoring by world-class entrepreneurs, CEOs, industry, physicians, certainly, financing experts of various types that we draw upon, again, pro bono from our fairly vast network, thanks to Dr. Fogarty, throughout Silicon Valley. So all that type of mentoring, also clinical input. The Fogarty Institute seems sort of unique to me in terms of incubators that we've, of course, looked at around the nation. We have an important strategic partner. It's a community hospital, El Camino Hospital. With that partnership, our innovators, they actually can get hospital badges and walk in, observe in an OR, observe in a cath lab, see procedures happen. These are procedures that are relevant to the device they're developing, and they can really have rapid design cycles for their innovative process. Additionally, we have, besides the incubation program at the Fogarty Institute, we actually also have a clinical research program. We manage about 42 clinical trials at this point. The nice thing about that is, of course, most for you, the software, et cetera, people are excluded perhaps. You're going to have to do some sort of clinical trial. When you start that clinical trial, it will, of course, depend whether it's non-significant risk or if it's a PMA, et cetera, et cetera. With our clinical research program, our innovators can go right next door to us, talk to a research staff, and understand what considerations they should be taken into account even now as they approach that threshold into the clinical space. And then, of course, we have space. It's much more, again, geared towards medical devices, medical technology. So we have a workshop, an engineering prototype shop. And then we do provide some funding. Again, it's more on the low side, probably in the $10,000 to $100,000 per company range. Really, the intent of the Fogarty Institute, this Valley of Death, everybody talks about, there's probably multiple valleys of death, but it's to get the reason why they come to the Fogarty Institute, of course, is because they can't get money from anybody, really, except maybe some mom and some friends. But at the Fogarty Institute, what we do is we help them build technical and business validation so they can become fundable, do an A round of sorts, and then exit. At the Fogarty Institute, therefore, the way we try to facilitate that is we're becoming a venue for convening. That is, we have our innovators, and then also we develop relationships with angels, angel groups, and venture capitalists, so people can develop relationships that evolve over time at the Institute to facilitate the funding that's needed.
So you've touched on this a little bit, but I want to start drilling down now. So let's look at specifically, each of you, why you do what you do. And as we've charged so clearly into the audience here, exactly what problem do you think you're solving? So why are you doing what you're doing, and or exactly what problem are you solving? So maybe Hallie, let's start with you.
So why I do what I do. So Rock Health actually started out of a graduate school project with my co-founder, who's an MD, and we were both MBAs. And we were looking around at the kind of the ecosystem about being a digital health entrepreneur, and found that it wasn't as inspiring as being a tech entrepreneur. And there really wasn't that support system and culture of creativity and fun that there is around consumer web. But healthcare, more than any other sector, deserves the attention from really smart entrepreneurs. And so we worked with a professor to understand the space, who was in the space, what were the biggest barriers, and kind of our solution was Rock Health. And it was named after the Rock Center for Entrepreneurship at Harvard, which the Rock Center is also here now. And so we feel like we're really filling that gap. And one of the important things that we recognized in our research was that there's this, what we call a doc-dev divide. So there are two very siloed worlds. Developers tend to hang out with developers. Doctors tend to not have time to do anything outside of being a doctor. And there are a lot of ideas, and doctors are fantastic at identifying problems within the system, and developers are fantastic at building things quickly, and we really needed a place to bring these two groups together. And so we work really closely with providers. We have teams that come to us that have, our favorite teams are ones that are mixed. We had a team that just graduated last week that was a pharmacist and a developer. Borna on his team over there, they have a doctor on their team, and we find that the teams that have kind of these diverse perspectives with people with different backgrounds tend to be the most successful, and we want to see more teams that are cross-disciplinary.
So just as a narrative comment, the U.S. government is doing about all it can to make interactions between industry and physicians illegal. So when you think about what she just said, and when you think about the necessity for the interaction between physicians and medical device developers, it's just, you got to wonder what world we're in. But all right, let's just skip that one. So Reg, how about you? So why are you doing it, and what problem are you solving?
I'm doing this because I firmly believe that universities are excellent ways to solve wicked problems. I also, they're underutilized. I feel that the current healthcare problems, particularly in the pharmaceutical industry, is such a wicked problem, and we should be engaging the universities, particularly in solving it. And it's not something we can step aside from. My wife has Alzheimer's. She was a brilliant scientist. I watched this disease progressing. We need to solve this problem, and we just can't sit and worry about the money and the finances. We've got to solve and get the pharmaceutical industry working.
People estimate Alzheimer's will cost the U.S. $800 billion a year 10 years from now. So it would sure make a hell of a lot of financial sense to solve that problem for a number of different reasons. Andrew, how about you?
Okay, I think there are two answers to the question of why we're doing this. The first is a sort of corporate answer. The Royal Society, as a unique and elite institution of 1,400 of the world's best scientists, has an obligation to see how it can use its position to help the Valley of Death. And the two charitable objectives are, one, contributing to a culture change in the academic community so that a bit like Reg has been describing, more academics more of the time think more positively about more commercial activity, that they don't all have to do it all the time, but there has to be a change in the center of mass of that activity. And the second is, because we have a unique brand, our activity, relatively small investment activity, can leverage other people into this area. And in fact, particularly the angel community has responded really positively to our presence because they have money and they have on-the-ground activity, on-the-ground experience. We bring the brand and the reputation. That's the corporate answer. I mean, the personal answer, why am I doing this, is my background is running technology companies, and I've run a substantial publicly listed technology company and also a privately a venture capital-backed company. I'm the only person I've met who's run spin-out companies from both Oxford and Cambridge University. And I'm pretty safe saying that here because I doubt there are any, I doubt there's competition here. And I had I have to say that the complexity of running a public company is as nothing compared with the complexity of running a VC-backed company. It is such an inefficient way of growing a business, and I found that was a very dispiriting experience. I'm sorry to sort of be negative. I was told not to be negative. I think there is so much opportunity to do this even better, and the Royal Society gave me a chance to try out some new things, and that's what we're doing.
Super. Mike, how about the Fogarty Institute?
Yeah, the Fogarty Institute, and again, it starts with Dr. Fogarty. Throughout his career, and he had a long career as a VC, as a founder of companies, it's always been driven by patient benefit. You look at our website, and it says it's about patients, not patents, for example. Again, that's very, very difficult, especially in this economic time. You see, maybe led by the sort of dysfunction in the regulatory environment around here. You see sort of a creep of innovation going overseas. And so anything to keep that innovation happening, especially here, capturing the wealth of great ideas that's here, that's why the Fogarty Institute was founded. We have some, in terms of our model, I've heard some of our innovators say, wow, this place is great, because typically, if you're out on an island trying to start a company, say in the medical device space, maybe you have one physician, you have some engineers. So you have a few engineers, and maybe you'll bring in some physician expert once a month. So it's engineers, it's a bunch of engineers and maybe one or two physicians. We reverse that paradigm, where we have a small team of engineers, and we bring together a large number of physicians, again, from our contacts and from El Camino Hospital, and so to really propel things forward. When I think when we talk about nonprofits being involved in the innovation support, this is really a special business sector, of course. Life sciences, that word life. If this was some other business sector where the model just wasn't working, where arguably the numbers that Allan showed doesn't really look like it's working in some ways, people could just run away from it. But because of that moralistic aspect of our business sector, I think that's why you see, one reason perhaps, you see nonprofits jumping into it.
Well, in a seventh of our economy, we spend twice as much as every other major country in the world. We don't have any discernible health benefits from spending twice as much as any other country. We don't live longer. We don't live healthier. The system could hardly be more broken at every level. So, all right, let's start with the hard questions now. We've been doing softball kind of stuff here, so you guys need to help too. So let's get some questions from the audience, and let's start with tough ones. So, incubators and a lot of these efforts have often been called dog pounds, not really accelerators. It's the weak and the sick who can't get funded elsewhere, and they find a home and they stay there and they never leave. So how do you prevent that from happening in your organization, or disagree with that premise if you choose?
No, I think you're absolutely correct. Before we got into this, we did a survey of incubators around the country, and many of them are geriatric wards, right? Just as you said. And the trouble was, why is that happening? One is that there's the same with venture. Often when someone started, you don't want to kick them out because they were almost going to get it. So we have a very strict amount of time people can stay with us, and that helps to get them out.
So you use a timeline factor. Hallie, how about you?
Yeah, we also have a pretty structured 5-month program. So at the end of the 5 months, you're expected to be on your own and move to the next level of business. We do love dogs, though. We have a dog in our office.
We used to refer to stopping funding on weak companies as drowning puppies, but that's a bad way to put it. So, and we're very dog friendly, and we have dogs in the office too. Mike, how do you guys handle getting companies through the process and out the door?
Well, we like to think that part of it is the way we select our companies. We go through a very rigorous selection process where we get especially physician eyes on opportunities, applications very quickly to understand what's the clinical need it's addressing and how feasible is it, et cetera. Beyond that, though, we we bring them in, and one of the first things we do, probably is put together a project plan with milestones. And as part of their arrangement at the Institute, they need to meet those milestones, or convince the board of directors at the Institute that they had to change their milestones for whatever reasons, which of course we understand. So we're definitely in the camp of, the Fogarty Institute is relatively young. We probably really came out of the gates a year or so ago. Right now we have 9 companies actually percolating at the Institute. It's not a huge number. So since we're sort of bandwidth constrained, we really have to follow the practice of fail fast. If it's not going to work out, hey, it's cool, and we'll part ways if you're not hitting milestones.
Can I add one point? The other thing that we don't do is we don't do subsidies. That was another thing that you saw failed. So everyone who's in our incubators are paying full market rent, which is quite expensive around here at Mission Bay. So that was one thing. As long as people have to work hard to raise the rent, and if they can pay the rent, they can stay.
Sorry, Andrew, I know your effort is kind of new, but so you haven't had the companies in there that long. But what are you doing in regards to the question of failing fast, and how do you encourage that in your group?
Well, we don't have incubators. I guess 2 reasons. One is the Royal Society is not set up to do that, in the sense that it's investing nationally and will be investing internationally, and so having it sort of geographically confined incubator isn't the best way to do it. I mean, the other reason for not having an incubator is we're 5 minutes walk from Buckingham Palace, and the rents are absolutely crazy. So that is the last place in the world.
Don't they have any spare rooms over there?
Not a lot of spare room, I can tell you. So we work very closely with the incubators around the country. Typically, so far, we've been investing in spin-outs from universities, from academic institutions, and many of those institutions will have, similar to Reg's outfit, but less developed perhaps, but they'll have incubators locally, they'll have entrepreneurs locally, and we plug into that. We're not big enough to solve those problems ourselves, but we complement what's on the ground there, and we bring the brand and we bring the technical connections.
Do we have a question, Dominic?
Yeah, we'll do one question. Anyone raise your hand?
My name's Joshua Sestak again. My question kind of revolves around this. A lot of the entrepreneurs here, I mean, there's 150 or 170 of us, and we're in these early stage companies, and we're all clamoring for the opportunity in such incubators that have these specialties, and so how do you kind of delineate yourself from the group when you're this early stage and not fall into the trap of just being, oh, that's a great idea, you should continue working on it, but we're going to go with this company that's just a little bit further along. And so how can we kind of continue to develop our plan, and whether it's pharmaceuticals or whether it's IT space or devices?
I mean, I would say for us, it's, again, it's, we try to get the very experienced innovator physicians on our application. They're part of our review process. And so with that wisdom, being able to see the kernel of the idea and what is the potential when it does go through commercialization and delivered to the patient. So we don't look as much at the development stage, but what is it at its essence, and where will it go? We have even in that range of 9 that are in residence now and 10 total we've had, it ranges from just a very raw a PowerPoint to something that's been a device that's been through preclinical studies in an animal.
Can I say there's 2 things. When for the incubators, and this is actually, I was just in the Dispendi Institute earlier this week, we have the same principle. It's very, very hard with a very early stage company to know whether it's going to work, right? It's such an amazing combination of the personal talent, the idea, the market, and so on. It's almost impossible to judge, to be honest. So what we try to do is just let as many people start as possible. If you can raise the money and pay the rent, come into the incubator and have a shot. And so it's more or less using sort of biological selection rather than instruction construction processes, right? You let everyone try it and see which one wins. We don't do that with our fund, right? But I have to say that having just watched, say, the success record of, say, the Sand Hill Road investors here, I don't think they could do just as well by putting a pin in a map than trying to actually decide. Because the ways that someone just said that what's 50% luck is what it decides whether any investment's going to be successful. It's really hard to know who's going to win and who we should invest in.
So we're a little short on time, and we're going to need to wrap up. But I want to ask one question of all of you, and try to be a little bit more specific to the audience. So I think the metrics are not number of things started, number of employees employed, or number of square footage occupied. I think it's exits from an investor standpoint, and I think it's patients helped. It's technology translated to patient benefit. Those are actually the metrics that count. So can you give us examples? Let's go down the line. Can you give us examples of one of the companies that you've worked with who got funded, went on to become successful? What was it about them that made them stand out to get that funding to hit towards the finish line?
So one of our first 10 companies was acquired for $25 million because it had a way of tagging DNA that was particularly unusual, and it was picked up very quickly by Affymetrix. And so that's how they made it.
How much cash in?
I think it was about $1 million in.
Beautiful. Andrew?
We've had no exits yet. We're too young to fail. But we have made
Indicia of success. What is it you think in the companies you're working with that is likely to make them fundable? What's the thing that stands out?
We have one example. We have two investments, follow-on investment in a business that deals with liver transplants. So it prolongs the time between the donation of a liver and the transplanting of that liver, and it increases the time from 2 to 3 hours typically at the moment up to 24 to 48 hours, which transforms the logistics of how you do organ transplantation, in particular liver transplantation. And the main reason we looked at that and invested in that was that there was 10 years work between a clinical transplant surgeon and an electronics engineer trying to solve the problem of how you persuade a liver that it's still inside the body when it isn't still inside the body. And that combination of an electronics engineer and a transplant surgeon was a very powerful trigger for us, because that's unusual. Interesting things can happen from that.
That's a lot of people forget, but there's gobs of non-dilutive capital out there. So Smart Cells, that one we talk about in Boston, 10 million in, 400 million out. There was also 10 million in non-dilutive money in there. So going in after somebody's already spent 10 million and you've got that visibility, it's kind of a big advantage. Hallie?
Yeah, I mean, unfortunately, the best metric at our early stage is follow-on funding. If angels, really smart angels and VCs are investing in our companies, then we know that they've done the due diligence and are putting a bet into a company that they think has huge outcomes, both financially and from a public health standpoint. I'm not going to name any specific companies because I love all of my children equally, but if you go to rockhealth.com/portfolio, also a bunch of our startups are here, CellScope, SenStore, Agile Diagnosis. You can talk to them and see how wonderful they are.
And Mike.
Yeah, I guess an example of a company that's graduated and had an impact is easy because we have one. That would be HeartFlow. Some of you may know it's down in Redwood Shores. They have a technology to use 64-slice CT data, so imaging data, to understand where in an arterial tree you have an occlusion. What this is going to do is going to eliminate approximately 1 million unnecessary cardio catheterizations in the United States and save up to about estimates around $13 billion. So that the indication that could have been a winner when we started with them was it's the obviously disruptive nature of what they're going to do. At this point, they've raised in excess of $100 million and have an excess of 80 employees. So they're doing okay.
Thanks to all of you. Thanks for listening to us.